SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-Baffi Bocconi webinar on the value added of central bank digital currencies. When SUERF, together with Bocconi University, organized its first conference in Milano on who needs central bank digital currencies in June 2018, there was no talk about an e-euro. This changed quickly as the project of Libra, later relabeled Diem, was announced, as due to COVID, digital payments gained further importance, and most recently, as the prevailing global monetary order is being put into question with competition of large countries' currencies for global market shares gaining importance. Most recently, advances in and the spreading of artificial intelligence has brought to the forefront that digitalization is progressing fast and will also continue to increase its influence in the money and payments sphere. As a result, central banks worldwide, including the ECB, have embarked on projects to study, pilot, or even introduce central bank digital currencies. In Europe, on 28th June, the European Commission presented its single currency package. The package included assurances of the continued availability of physical cash, but more important for today's webinar, the package set out a framework for a digital euro that the ECB may issue in the future as a complement to cash. Let me recall some cornerstones of this proposal before we enter into our debate today. According to the Commission proposal, the digital euro would be available alongside existing private means of payments. It would work like a digital wallet. People and businesses could pay with the digital euro anytime, anywhere in the euro area. It would be available for payments both online and offline. Online transactions would offer the same data privacy as existing digital payments. Offline payments would disclose less personal data than, for instance, card payments, much the same as what is disclosed when using an ATM. Banks and other payment service providers across the EU would distribute the digital euro to people and businesses. Basic digital euro services would be provided free of charge to individuals. Individuals without a bank account could open and hold an account with a post office or a public entity. The digital euro shall be easy to use and suitable for persons with disabilities. And finally, merchants across the euro area would be required to accept the digital euro, so it would be legal tender, except for very small shops. The Commission proposal sets out the legal framework and essential elements of the digital euro, which, once adopted by the European Parliament and Council, would enable the ECB to introduce a digital euro. It will be for the ECB to decide if and when to issue a digital euro. Earlier today, I found a news article where, for instance, Bundesbank President Nagel hinted that a time horizon of 4 years might be realistic. We have an expert here to confirm this or say this is not the case. The public debate about the digital euro, which has intensified since the Commission's proposal, also circles around the question raised by the SUERF-Baffi Bocconi conference back in 2018. Do we need an e-euro? What is the user case? Which kind of digital euro do we need? Retail or wholesale or both? And what features should the e-euro have in order to reconcile various interests and pros and cons? We have an excellent lineup of speakers with us today to discuss these issues in depth. To start with, Maria Demertzis, Senior Fellow at Bruegel, will present key findings from a recent study on the value added of central bank digital currencies, a view from the euro area. Then 3 top experts will comment and add their own perspectives. Morten Bech, Center Head in Switzerland of the BIS Innovation Hub from the Bank for International Settlements. Dirk Niepelt, Professor at the University of Bern and a SUERF Fellow. and Ignacio Terol, Digital Euro Product Manager at the ECB, will all provide their comments and inputs. Without further ado, may I hand over to Maria.
Ernest, thank you very much for the introduction and also for the invitation, to the opportunity to talk about the paper that we completed very recently on the value added of central bank digital currencies viewed from the euro area, as suggested. But in order to do that, we also looked globally to try and understand the aim of the project and indeed what the value added of central bank digital currencies is. Okay, so this is indeed the project that we've embarked on. This is not the first time that I had written something for CBDCs. As early as Ernest, you were talking about the original event that you had. We had written a paper at Bruegel on indeed what are CBDCs and why might they be of interest to the consumer, ultimately to the consumer. But indeed, the second attempt, which is what you have in front of you, to talk about CBDCs, it came out of an observation, and the observation is that there is, and that brings me to my second slide, there is a gap between the speed at which CBDCs are actually advancing and the public's understanding as to what they are and why they may be useful. And this attempt that my colleague Katarina Martins and myself had taken is very much an attempt to try and close that gap. This is a picture of the CBDC tracker of the Atlantic Council, in which you can see that there's now 130 countries that have got a project of CBDC at different stages of development. And what you see here on the map in pink are the countries that have already launched CBDCs. And then you have the other colors representing different stages of development. The green is fairly advanced, but not yet there. The light blue, of which the euro area is one of them, is at some sort of advanced level of thinking about CBDCs, but not yet in any implementation phase. But the fact of the matter remains that there is a lot of interest in CBDCs, and indeed the countries that have actually adopted CBDCs and where CBDCs are in operation, these are the countries in pink on the graph, and there are 11 of them, are the ones that are leading the discussion in terms of what CBDCs are and why they might be useful. If you ask those central banks of these 11 countries, what is the motivation behind launching the CBDC? The first thing that they will say a number of things, but the first thing that they will say is they're aiming to promote financial inclusion. There is a big component of their respective populations that is excluded from digital payment and indeed digital financial services. And the aim of the central bank in these countries is very much to bring a big proportion of their population inside the financial system, certainly the digital financial system. I don't believe that financial inclusion is the biggest motivation why jurisdictions like the euro area cares about the CBDC. It is one of them, but it is not the first one, and perhaps not the most important one, because of course the euro area is a system where we have rather developed financial services and where financial exclusion is a second order problem. With that, I will make one more comment on financial exclusion, and then I will not refer to it anymore. But I recently looked at the numbers of financial exclusion in the euro area and indeed in the whole of Europe, and I will say that the numbers were not as good as I thought they were, and therefore the issue of financial exclusion should also not be underestimated, even in jurisdictions like the euro area. But in any case, I think the most of the arguments behind the interest of the CBDC in the ECB and in the US, let's say, are of different nature. So going then to sort of what are the motivations, because I start from my starting point is to try and understand what is the externality that requires public intervention. And I think it's very important to try and understand the nature of this externality if we are to answer the question, what is the value added of central bank digital currency? What is the problem that we're trying to solve that requires a public intervention, in this case, of course, of the central bank? What we hear from central banks across the world, including the ECB, are the following. central banks got very interested in CBDC because of the emergence of crypto. Public currencies that were available digitally and across borders were at the time, less so now, but at the time they were thought as an alternative to sovereign currencies, and that of course would jeopardize the ability of the central banks to implement their job, which is monetary stability and financial stability. The second one is the one you also refer to, Ernest, in your introductory comments, and that is the increasing digitalization of payments and the possibility of having digital payments exclusively and instead of physical cash. Physical cash is often referred to as the anchor of the system, where we all run to when there is problem. And the worry here is that if digital payments were to take over, are we in any way jeopardizing the existence of an anchor to the financial system? Would it be important to provide a digital equivalent of the physical cash in order to avoid that? That is a second motivation. And then, of course, there is always a need for improving the efficiency of payment systems, both within any given jurisdiction and across jurisdictions. So, looking for ways to improve payments is, of course, something that central banks always care about. And then finally, and in the context of the euro area, an argument that is coming from the ECB is the argument of strategic autonomy. We often hear about the number that 70% of all payments in the euro area are intermediated, so the service provider, by firms that are not European. Is this an issue, and wouldn't we want to have European firms or European means of providing for domestic payments? Now, turning then to sort of a little bit more detail, there are two uses for the digital euro, just like the physical euro. One is for retail use and one is for wholesale use. Just like for the physical euro, retail means in small amounts, wholesale means big amounts, typically by banks themselves. And the ECB up till now has talked mostly about the way of constructing a digital euro for retail use. And it's only very, very recently, I mean days, since we heard also from the ECB that now there will be greater interest also in thinking about the digital euro also for wholesale purposes, which I think is an important thing. What I'd like to do next is go a little bit through these arguments and perhaps give you my answer to the question that I pose, which is where I see the value added of central bank digital currencies, and in particular where I see the value added for the euro system. Now, let me go through the arguments one by one. Crypto, is this taking over the world? In short, I think not. We still see that the value of crypto assets is below 1% of all total global financial assets. Now, that doesn't mean that this doesn't pose a risk in financial stability. I am very much in agreement there with Mr. Panetta when he said that we need to worry about financial stability and what glitches in the crypto market can mean for financial stability across the world, but they are not, at least at the moment, the way that we see them, they're nowhere near being a threat to sovereign currencies or to other means of payment, particularly in the euro area. And in any case, crypto are mostly used for investment purposes. 77% of all its use is for investment purposes, much less so for payments. So the fear about crypto taking over, in my view, isn't justified, at least in the present. The future, of course, is something different, and we can come to that. Then my second argument is, what about the digitalization of payments? This is a graph from data from the ECB in terms of how much do we actually use digital payments and how much do we use cash. I must admit, I was actually surprised with this data. I am particularly looking at this graph here, the value of transactions. We still see that after the pandemic, in 2022, 42% in terms of value of transactions was still done in cash. I was actually very surprised for this. I thought this number would be much, much smaller, but we actually see that cash is still very much used in the euro area, and therefore the question is, is really digital payments going to take over over cash? Is cash going to disappear? And in order to try and answer that question, then we looked also to the graph here to the right, where we really directly ask, this is again data coming from the ECB, we really ask the question, do you really want cash to remain, or do you want it to go away? And actually, if you look at the red and the green numbers, more than 50% across the euro area, with important differences across countries, of course, but more than 50% of the individuals in the euro area believe that cash should stay. And I think this is very much behind the motive of the ECB saying that the digital euro is not there to replace physical cash. It will be there to run in parallel with cash. But the fear, which is part of the motivation while we're looking at CBDCs, the fear that cash is going to sort of be eliminated is, at least from the picture that we get today, not very much founded. Then what about the evidence so far? Now, this is a comparison that is not entirely appropriate because we're talking about jurisdictions with very different motivations in the way that they use the CBDCs. But in the 11 countries where CBDCs are being actively used, the pickup, the take-up of CBDCs hasn't been very impressive. Now, it is true that it's only been a couple of years that these currencies are in operation, but we actually see that the take-up of the currency hasn't been as big as we would have thought, given, of course, what the motivation is. In countries like Nigeria with the Naira, the Bahamian Sand Dollar in the Bahamas, and also we have here the Chinese yuan, which is not full operation, but it is in pilot and therefore is being used. But we see that representing very small proportions of the total currency in circulation. And the question is, why is that? Why hasn't the digital equivalent of sovereign currency taken up more in these countries? And the reasons that we get back when we ask that question is, first of all, there is a public confusion between CBDCs and cryptocurrencies. They are the public believes that they are the same thing. And if you take in jurisdictions like the Bahamas, where Bahamas is also a big center for crypto, this confusion is all the bigger in these jurisdictions, and therefore those who worry about crypto really also worry about the CBDC. The second argument we hear is that while the infrastructure for being able to accept CBDCs is given to these countries for free, namely is financed by the central banks, not everybody understands that, and therefore they do not take up the infrastructure that is necessary to be able to, if the merchants, for example, to be able to accept the CBDC. And then finally, there is, in some of these jurisdictions at least, there is fundamental lack of trust in the currency, and therefore the digital representation of this currency isn't necessarily the way to solve the problem of lack of trust in the currency. Now, what does this mean? What does this mean in terms of the way we're going forward? In the paper, we go into great lengths to try and explain what we believe about the digital euro. Here is a small summary of our arguments. The case for the consumer in terms of having a retail use of a digital equivalent of the currency, certainly in the euro area, is very mixed. And what I mean by that is that it will make very little difference currently to the consumer of having a CBDC in their wallet, in their wallet, right? The digitalization issue, in our view, is not so much of a problem. There isn't a threat of crypto taking over. Also, there isn't an issue about the cash not being there. But why should the consumer have one extra means of payment in the form of a CBDC, in particular if that form is going to be, as we hear, only between 3,000 and 4,000 euro in a digital wallet. Financial inclusion, in my view, is by far the most compelling reason for having a CBDC, but the take-up is not what we would have wanted. There is digital penetration in the countries that is lacking, and therefore, this is the first thing that needs to be resolved before we can introduce CBDC. I also believe that the welfare implication of having a very big intervention in the system are very understudied. The ECB is telling us that, of course, the provision of CBDC, of the digital euro, is going to increase competition. I think it's important to understand also on the other side of the argument, what is the distortion that such a big player is going to generate in the market for payment systems. And I think it's very important to understand the pros and cons if we are going to justify the externality that the ECB will be trying to solve. And then there are many concerns with certainly at the public that have to do with privacy, that have to do with anonymity. Perhaps we can discuss this in the discussion. I personally do not worry so much about privacy issue, but let me come back to that in the discussion, simply because I think it's a very important point and one that we really need to concentrate in. However, when it comes down to the CBDC for wholesale purposes, I really think here there are many advantages to be had. The BIS, and we are going to hear from Morten in a minute, but the BIS has done really excellent work when it comes down to the types of things that we need to think about. I certainly recommend all the work that the BIS has done on this by means of understanding where the value added is. See, recent experiments that have been done between central banks across the world show us, and here is a small summary of them, that there are huge efficiency costs to be had cross-border, and I should say by cross-border I mean cross-currency, by introducing the new technology, by also the ability of central banks to be able to talk to each other. There are gains both in time, you can see here in the table, anything from reducing days down to seconds, but also in costs, by simply eliminating corresponding banks, which is basically now at the cornerstone of cross-border wholesale payments, and going into peer-to-peer. So banks talk to themselves directly through their own central banks. So there are huge benefits to be had, but you could still ask the question, well, why can't we not have those benefits in the current infrastructure? Why do we need to create a new infrastructure for this? But I really think that it is really the ability of central banks to talk directly to each other, any two central banks in the world, that is going to give us the benefits in terms of both time gains but also cost gains. But it comes also a creation of CBDCs for wholesale purposes cross-border comes over with bringing important changes to the global financial system. I actually think that there is going to be a small revolution if we ever were to get into the system where we have central banks that are capable of talking to each other. It is possible to revolutionize the global international system, and the revolution will come in the form of moving away from a dollar/euro based international payment systems into a system that any two currencies via the central bank can talk to each other. Where the current system, for a vast majority of payment system, reserve assets rely very much on the dollar and on the euro, the potential for replacing at least the payment use, not the value storage use, but the payment use of the dollar through CBDCs, in my view, is enormous. And here the BIS again is telling us how the potential forms that this could take. I have here a schematic representation of what the ECB tells us. You can have banks in one country having accounts in their central bank that already exists. But what could be novel is for banks, domestic banks, having accounts in a foreign central bank, and therefore being able to transact between two corporates that trade very, very quickly. This is indeed where the benefits can come from. You will be eliminating the middleman, which in this case, of course, are the intermediate steps coming from corresponding banks, and allow banks to communicate directly with central banks. This isn't for tomorrow. This is not a small project. There are important and very big obstacles that need to be resolved. And again, the BIS is very clear about this. There's technology, economic choices like counterparty risk. But perhaps the most important one is the governance issue. How is the system going to be governed, under which law, and who sets the global standards? And it is the global standards where I believe that the European system and all the good work that the ECB has done has a lot to add to this conversation. I remind you, and this is where I'm coming to the end, that I believe CBDCs could be used for geopolitical purposes, even if we believe that we want to hold the dollar and we want to hold the euro because they're good currencies and we want to use those currencies for global settlement purposes, through sanctions and through the geopolitical, the weaponization of financial instruments, we are finding that countries are being excluded from being able to use the dollar and indeed the euro. Since the Russian invasion of Ukraine, the instruments of wholesale CBDCs, so CBDCs for wholesale purposes, has doubled, simply because the countries are now looking for ways of de-risking their payment systems, finding ways of bypassing the potential of sanctions. And this is where also I believe the European system, the ECB, needs to participate with greater eager in some ways. So if I were to sum up and coming to the end, the case for retail CBDC in the euro area is mixed, at least in present. However, we hear from the ECB that we need to be future ready, and there I am in total agreement. We don't know what the future would look like. In any case, it would be important for the euro system to be prepared for a future that would become increasingly more digital. And therefore, all the efforts that are being done at the ECB right now, I think, are very well placed in order to identify the important trade-offs that the system will have to be confronted. But I also believe that the European system needs to participate more actively in tests that are happening globally on the wholesale. And because I believe it is now that the standards are being created, and we know that whoever is well advanced into the game will be the ones that are setting standards. And this is why I would like to encourage the Euro system to participate in more of these global tests that are being done. There are enormous gains to be had cross-border, and why not benefit from these cross-border efficiency gains, and at the same time contribute in the conversation that will go on increasingly so in the future, of having central banks talking to each other directly when they settle transactions and therefore change the current financial system. That's all for me right now. I'll stop here. Thank you.
Thank you very much, Maria, for this excellent introduction and overview, and for the many a little bit controversial points also that you raised. Among them, what is the use case? What is actually the value added? Is there a justification for a dominant public player to enter the market for payments? What are the externalities that are resolved through this action? And I'm sure that our discussants will have a lot to comment on these points. Let's start out with Morten Bech, Center Head Switzerland from the BIS Innovation Hub. Morten, over to you.
Thank you very much, and thank you for the kind invitation to join this excellent webinar. First, let me say I think it's a really nice policy brief that Maria and co-authors wrote. I think it provides like an excellent overview, just as the presentation actually, of the current debate around central bank digital currencies. I certainly learned a bunch of new stuff. Even though Maria mentioned that the comparison might not be appropriate, I really like the one where it was the numbers on CBDC over currency in circulation. I find that very illuminating. And I think it illustrates this thing that central banks might be entering into a new world where they don't have necessarily monopoly on the issues of banknotes, on electronic forms of money. You might not be in the same monopoly position, so you really have to work harder in order to ensure adoption and acceptability and so on and so forth. And also, I just say that I think it's really important that academics and the public at large challenge central banks, what they're doing in this area and elsewhere. So I really think this is a great debate. I should just say, I don't have an opinion on the digital euro per se, right? The ECB is a major shareholder at the BIS, so I'll talk in more general terms about retail and wholesale CBDC. And I will organize my discussion very simply. So first, what is CBDCs? And to me, CBDCs are all about making M0 or base money great again. And so base money today consists of cash and reserves. So those are balances that commercial banks hold with the central bank. And so why is M0 not great? So I will try and take the components in turn. So first I'll talk about cash and retail CBDC, and then talk about reserves and wholesale CBDC. So why is cash not great today? I agree that the cash is still popular, but I would say less so for payment purposes. And I think the use of cash will change within a generation. I don't think Gen Z does not use cash. And I really think the adoption of cash or the affection to cash is really a generational thing. The store value might also decrease as interest rates have gone up. I like to say that no matter the question around the future of payments, cash just cannot be the answer. It's dirty, it's expensive, and can only be used for transactions covering the distance that you can reach with your arms. So also, I'm from Denmark, so if you want to look to how the future would look, you should look to the Nordic countries. And in Copenhagen, seeing somebody pay with cash is as rare as seeing a fish on a bicycle. And there's plenty of fish around Denmark, and there's many bicycles. So you just don't really see that anymore. And in Denmark, kids down to, believe the age of 13 have this very common mobile payment app, and they're all running around paying each other. I actually had to get like a Danish cell phone number in order to be able to have that app and use that. So I'm basically paying a mobile subscription every month just to be able to do mobile payments when I'm in Denmark. And so cash will go the way of the rotary phone or CDs. I know that central banks are saying that they will provide cash as long as there's demand, but just at some point, the economics of that just doesn't hold true. There's a high fixed cost. At some point, that's just going to be too expensive to keep providing cash. So what are the alternatives? I think the brief mentions the PIX system in Brazil as a nice example of what is possible, both in terms of financial inclusion, but also efficiency. And PIX is and other instant payment system around the world are just great. And if implemented right, they can be a real force multiplier for the economy. But one of the problem actually with instant payment system are that person-to-person payments are for free. So revenue is really only generated from charging merchants at the point of sale. But here you're actually competing with Apple Pay and Google Pay. And they will always be cooler. So I would just be worried about that being the model for the future. And I think this lack of revenue on person-to-person payments is a problem because that leaves less of an incentive to actually invest and innovate in the system. And apologies for another Danish example, but I believe it was in 1983, banks in Denmark were allowed to abolish checks by actually implementing a electronic debit card. And they promised to keep that for free forever. What this actually meant that this debit card was probably the last debit card or card in the world to get a chip implemented because there was no incentive to invest in the technical infrastructure. I believe in South Africa, they're actually rolling out now a system where you actually have to pay. There's a small fee for payment. And I think this is going to be very interesting to watch. Offline is something that would need to be solved in any electronic payment system. I don't think we're quite there yet, but I have full faith in technology as we go forward. So the BIS really sees the future of the monetary system as one with a retail CBDC. I think the idea really is for it to be distributed through banks or other payment service providers. In other words, I would say a retail CBDC is not a question of if, but of when. And some argue that what are the reasons for this? I think some argue, and convincingly, that it's all about the singleness of money, which has served us well for centuries. So retail CBDC would be one way to ensure that. Others are arguing that it's the privacy, as Maria also mentioned, and And that is an important thing, because the central bank is the only one that can credibly commit to not monetize the use of your data. But the question is then whether privacy is enough to ensure sufficient adoption of a retail CBDC. And the PBOC's retail CBDC, for example, have different privacy level depending on the size of the transaction. And I think that is one option. In the Innovation Hub, we're actually exploring several other ways of doing privacy. Let me just mention one, which I think is particularly interesting. We are exploring this notion of one-sided privacy. Cash has two-sided privacy. You do not learn anything about the payer and the payee from just seeing the transaction. What is on one-sided privacy? That is where the identity of the payer is not revealed, but the identity of the payee is. And so one example is me going to a pharmacy and buying a legal drug, but if you can see the price, there's a high likelihood that you could actually guess what drug I'm buying. But for the pharmacist, this is no problem that you can identify her, or you can see the price. She's in the business of selling this drug, and she's not seeking to avoid, say, VAT or something like that. So maybe one-sided privacy is the right trade-off between trying to give consumers privacy and avoiding illicit transactions. So and then there's a lot of things around retail CBDCs that we can come back to in the discussion. So let me try and just quickly to turn to wholesale CBDCs. And I'm not saying that reserves are not great. So why are they not great today? So actually, I think so-called RTGS systems, or real-time gross settlement systems, are really doing a good job around the world. And we are even seeing several countries upgrading them as we speak. But reserves might not be great in the future. And I see three main scenarios for the introduction of a wholesale CBDC. The first one is, as Maria mentioned, if the private sector cannot figure out how to solve cross-border payments, yes, then central banks might need to do something. Second, if the private sector moves to tokenized securities, so if securities are put onto these DLT platforms or something like that, then I think you would need some form of central bank money on there, which would be a wholesale CBDC. And there's also a lot of talk at the moment around potentially banks starting to use what is known as tokenized deposits. So again, putting their liabilities onto a DLT or blockchain platform, presumably a private platform and a permission platform. So let me just quickly touch on the cross-border payments. Maria highlighted this thing that the key thing for a cross-border wholesale CBDC system to work is really if central banks start giving access to non-resident financial institutions, so basically institutions from other jurisdictions, because then you can cut out the middleman, which is now the corresponding banks, and I think that could be a game changer. I should note that actually happens already in Switzerland today, where you can be a German bank, or you could be a UK bank, and actually have a direct account relationship with the Swiss National Bank, even without having a physical presence in Switzerland. So it's actually possible also in the current system, but it is a big step. So it's not the technology, it's the technology the BIS Innovation Hub has definitely shown can make it work, and it's definitely feasible, but it's more about actually this point around access. So I think I've spoken for around 10 minutes, so let me stop there, and I look forward to the discussion.
Thank you very much, Morten, for sharing these thoughts with us, which complement the introduction by Maria in a very good way. Now, I hand over to Dirk Niepelt for an academic perspective, maybe.
Thank you very much, Ernest. I hope you can hear me well. Thanks to Maria for the introductory presentation. I'd like to make 3 points related to what Maria said. The first one concerns central bank motivations for CBDC. The second one concerns what you called the use case, or why should we actually go for that. And the third one concerns wholesale, very briefly. So let me start with the first one on the central bank motivation. I disagree a little bit with what Maria suggested, that central banks were concerned about crypto. At the very beginning, I think there was a bit of confusion also in central bank circles about, what is crypto, what are stable coins, what is CBDC. Everything was sort of put into the same basket. But pretty quickly, I think central banks realized that crypto is not that danger. What really paved the way for CBDC discussions, I think, was Diem. So the idea of a stable coin that could essentially lead to dollarization of some type, but not really dollarization in terms of Bitcoin taking over, but really dollarization in terms of the dollar taking over in the euro area or something like that, or in developing countries potentially, and therefore changing the financial sector in a developing country, leading to dollarization, leading to undercutting financial repression in countries like that. So I think that was one of the main motivations to think about this. Now, more specifically, when we think about the digital euro, the ECB in its progress reports has emphasized, and Maria also mentioned that, the strategic autonomy of Europe as one of the objectives. The ECB has mentioned the willingness to provide alternatives to expensive, essentially American service providers, credit card companies, and it has emphasized the robust monetary anchor in times when cash use were further to decline. I think in addition to these three explicit objectives that the ECB mentions, there's a fourth one, and that's basically the elephant in the room, which has totally taken over. And this fourth objective is do no harm. Do no harm is a very sound principle, but the ECB interprets that as do not change the business models of banks. And that has led to a lot of precautions that the model now is envisioned to take. And all of that has completely taken over the project, in my view. So the project is, let's play a little bit around with these things, but not really change anything at the root. Now, whether this is the sound approach or not, I don't know. What I do know is, at least to my taste, that decision has been taken a bit too quickly. I think there would have been time and space to think a bit more carefully about what CBDC offers as options and whether we want to use those options to think more carefully about the foundations of our monetary architecture and whether we want to potentially change some of that architecture. That decision basically has been swept aside by the ECB now to the objective of basically maintaining the status quo and progressing as is. The second point that I would like to mention relates to the use case of CBDC. Maria mentioned that uptake has been very limited in the few countries that have tried it so far. And I think there's a couple of possible reactions to that. The first one is, and that's what the academic literature, some academic literature actually suggests, is that this need not be a problem. It could very well be that there's a good case for retail CBDC, even if it's not adopted. And the idea is that by presenting an outside opportunity, a central bank could provide some options to users, to customers, to citizens, and that could incentivize banks, offering better products, lowering prices, etc., etc. So banks might very well adjust their offerings and thereby maintain their market shares. Nobody might take up CBDC, but still it might play a useful role in terms of incentivizing the banking sector. That's point number one. The second one is that, as I mentioned before, when you build in so many caps and breaks and precautions, as the ECB, for example, now thinks about the digital euro, then of course nobody will take that up. Why should people take that up? If you think about it, the digital euro will probably not be more convenient to use than any other private sector product. So why would people switch? The digital euro would certainly not pay higher interest than what private sector products pay. So why should people switch? The digital euro will not be a particularly useful product for B2B applications. Actually, the ECB so far has not stressed the B2B applications, but consumer product applications. So there's no market on that side either. And people, if you ask them, people on the street, they're not too concerned about the distinction between safe public money and maybe a little bit less private money, as long as they trust in deposit insurance and the lend of last resort. That's not a major concern for them. So why should people switch? I think the answer is not at all clear. Now, the most important point, and let me stress that in my view, is the following. I don't see any reason for users in the euro area to switch to a digital euro, in particular, given all these caps and precautions that the current model has. But that is a shame, because there could very well be a good case for a retail CBDC from citizens' point of view. It could very well be that as a user, it doesn't really pay off to use that means of payment, but as society, as citizens, we could actually be much better off if many people were to switch, because this could improve transparency of the monetary system. It could improve competition, as we mentioned. It could actually, relax some too big to fail problems. It could help, reduce regulation in the banking sector. There's a couple of benefits that could arise and that we would actually like to have. So these are all externalities, as Maria called them, right? The individual user doesn't internalize these things, but society as a whole could very well benefit from these factors. So all of this suggests that if you take that perspective, you should actually subsidize retail CBDC in order to make people adopt that, rather than what the ECB now plans to do, which does the opposite, to basically keep people from adopting it in large numbers. The last point is or concerns wholesale, and there I don't have much to say because I'm a macroeconomist. I'm not really a payments person, so I don't understand that very well. And Morten made, I think, very clear, to me at least, what the main motivations for wholesale CBDC should be. So all I would like to add here is that, in my view, again, as a macroeconomist, wholesale CBDC is a no-brainer. I don't think, there's not much to discuss here. I think people will adopt it because these are just Pareto gains on the table. Everybody will benefit from that. It's basically efficiency improvement in the payment sector. Why would anybody be opposed to that? So I don't see much resistance here. I think, if there's ways to overcome these technological, or more, I should say, regulatory and competition boundaries between different jurisdictions, and wholesale CBDC can help doing that, then I think it will be adopted. Why not? The big difference is that wholesale CBDC will not change the monetary architecture. It will just be a marginal efficiency improvement in payments, while retail CBDC, if adopted to a large extent, would, of course, completely change our monetary architecture. Thank you.
Thank you very much, Dirk. I now hand over to our last speaker, Ignacio from the ECB. Please go ahead.
Thank you very much, Maria, Morten, and Dirk. We all pay in everyday life, and we all have our individual views on what will work, what will not work. I agree with what Maria has said at the beginning, that there is a communication gap on CBDC between what is in the academic reality, let's say in this kind of circles, and the general perception of the public. That was why, and by the way, the proposal of the legislative proposal of the European Commission is now putting really the euro area at the forefront of the G7 discussion, at least in terms of closing this gap. So from a project perspective, a very important element during this project, it was something which the ECB president asked us from the beginning, was to listen very much. And we have been listening a lot. First of all, we have been in regular contact as we were progressing in our design considerations with all stakeholders in the retail market, on the supply side, on the demand side. And what I'm displaying here, as we come to the end of our investigation phase, this is the feedback which the end user associations, those for whom the project is there, this is the feedback they have provided on the digital euro. So this is an extraction. You see the links in down below. So we are happy from our perspective that what is being considered is being valued by those associations which represent end users. But beyond the discussion with associations, it's also very valuable to listen to citizens directly. for us, it's been very important to listen into focus groups. I have listened myself to many of them, as much as I understood the language, because we have held focus groups across all 20 euro area countries with more than 3,000 citizens and merchants. So this is just an example of feedback received on the most valued characteristic of a digital euro. From the report we published, this was first half of this year. So I'm surprised in bringing a consideration. I'm surprised that this is not brought more from the perspective of many euro area citizens. If we, those of us who are old enough to recall the conversion of banknotes into cash, we know that we not only switched our unit of account from our previous currencies to the euro, which, okay, so that was an adaptation, but we also got a new means of payment with which we could pay everywhere across the euro area, and which also gave us a sense of belonging to the European Union, probably like no other element did before that. It happened, by the way, not with the introduction of the euro in 1999. The euro was in our accounts in 1999. It happened only once the cash changeover happened in 2002. So this is I would really recommend for making an evaluation, looking into the different studies from the Commission, from ourselves, from let's say all serious all service into what is brought by citizens and by merchants directly. I have a similar point, actually, though Dirk expressed it very nicely on the considerations of central banks. I don't think that crypto assets, we would not speak about cryptocurrencies. I don't think that crypto assets are our driver. What is true is that, let's say, the combination of big tech with billions of users, with the possibility to mimic through a stable coin currency, that's more of a risk. But let's say as it's put, that the risk that an unbacked crypto asset would become predominant, I would say, not even in countries like El Salvador or Venezuela, which don't really have a currency, which have tried to have it. It has not even worked, even with the government support. Why? Because crypto assets are not fit really as a means of payment for everyday payments, and they're also not stable in value. So our considerations, I think the speakers have raised them before, have reflected them very well. These are really, from the Eurosystem, are two key considerations. On, I think it's Space 2022 survey is really a rich, very rich. Also, it's part of our of how we're listening to citizens. And Maria, you provided a very interesting statistic. I will come to it later on. But this one is also very important. The fact that 55% of consumers declare a preference for digital means of payment, while 22% prefer cash. You were probably a bit surprised indeed on the use of cash. It's also because when it comes to person-to-person payments, and person-to-person payments are an important number in terms of volume of daily payments for many persons, those are very often when in proximity carried out with cash. So that's influencing a lot the overall usage. Yeah, when it comes to resilience, and because payments are really a basic need of our economy, we take them for granted until they are not there. So We are very conscious also, if you look into the US, China, Japan, you can identify what's the digital payment method which is widely usable, available throughout the euro area, throughout the currency area, sorry. In the area, that widely available and usable payment method is still cash. There's no digital equivalent at this point of time. Yeah. I would like to comment on because it's actually done this comparison which is used between retail and wholesale CBDC. I would like to argue, from my perspective at least, it's and I think Dirk, I think you mentioned something similar. For me, always when I listen to wholesale CBDC in particular, different people have different things in mind on what they're speaking. For us, wholesale CBDC is the already existing reserve money of banks in the central bank. It's not making the case for changing necessarily the access policy to the central bank. And that's the existing target services when we come to the euro area. And it's a bit earlier, so it's really 6 months ago, we have started also an investigation phase to look, well, let's say we have, I think we are really at the forefront there, again, from a euro area perspective. TIPS, which is an instant payment, 24/7 availability of central bank reserves for payments. That was launched in 2018. Many economies have launched their instant payment systems in the meantime. The Fed will be launching Fed now actually this month of July. So what is when it comes to central bank reserves, there's a question of access. Will central banks in the respective constituencies open access to the banks of other countries? I don't see this happening within the current geopolitical debate. I think the question is much more with the possibility to have 24/7 and instant settlement. How can you coordinate? How can you find the appropriate governance to facilitate cross-currency payments? And I would not want to demonize correspondent banks. I was myself 5 years ago in participating in a proof of concept where it was shown that it was possible with systems which were working 24/7 instant settlement. It was possible through the correspondent banking system to make payments really within a matter of seconds if you have the right coordination. But of course, there will always be competitive interests here. So when we speak about retail CBDC, it's about the evolution of cash. It's about making central bank money available in digital form to people and businesses for use in everyday payments. So I find it myself, in many ways, it's a comparable debate to that which existed in the 19th century on whether the state should issue paper money to complement the coins to adapt to the evolving payment habits. And to those who fear or who think that cash will soon disappear, I'm much more confident myself on cash. If you just take this comparison, consider that coins, so metal money, which was let's say the traditional form of money issued by the state until then, they're still around, and there's very unique features of cash, and I'll come later to the point that the focus on the digital euro has also obscured the fact that the European Commission has launched the legislative proposal, which can be which is probably since the launch of euro area banknotes, the euro area legal tender, the euro cash legal tender proposal is really strengthening and facilitating the rights of those who want to continue using cash, which is a very important right. So in my view, I think this debate is often positioned by what I see is that those who are skeptic of a retail CBDC normally position the debate about which CBDC is better. I don't really think this is I think they're really different things, and Maria was explaining it very well, because each has its purpose. One way to illustrate it, the architects of monetary union, when the Maastricht Treaty was written, they were never considering should it be better to provide the euro in the form of banknotes or in the form of central bank reserves. That debate never took place because, of course, for the euro to be really seen, noticed for a change of the unit of account, banknotes had to happen, but the euro also necessitated, of course, the changeover in the central bank reserves, which happened in 1999. There's one point which in your paper you is mentioned that with CBDCs, however, both the payer and the payee will have accounts directly at the central bank. There will be no commercial bank involved. And then there's a footnote there clarifies. So I think it's if you come from the perspective that this is a public intervention of central banks to replace the role of commercial banks, at least it's not the digital euro. So this is not connected to the digital euro we're thinking. I don't really consider that this is a public intervention. When you look into the global debate, what is common across all these 130 countries? What is common in all of them is the cash decline that is happening across most countries. Then there are specific motivations, but what is in any case considered is okay, as the use of cash declines more gradually in some countries, more rapidly in other countries, how to at the same time support cash, but also adapt the money to that the central bank offers to acknowledge the fact that already now and probably for the foreseeable future, digital will prevail. Yeah, so I think it's important to highlight, and this is done very well in the Commission's legislative proposal, that even if the digital euro is the liability of the ECB and the national central banks, even if the digital euro holders are not exposed to the risk of the access to the digital euro for the purpose of digital euro payment service, digital users shall only enter into a contractual relationship with PSPs. So we see very key functions of intermediaries, maintaining the customer relationship, providing payment instruments to pay with digital euro, authorizing and validating online digital euro payments. So for the performance of online digital euro payments, the needs to find the right balance between privacy and AML, CTF, fraud checks does not essentially change irrespective of whether what is being transferred is one payment asset or another. The discussion is coming with the digital euro because the digital euro is also the reflection that payments are becoming more digital. Yeah. And finally, a key function for intermediaries is also to obtain compensation as for comparable payment services. And That's an element where there was a discussion earlier whether the central bank will enter into a competition. The central bank is not really entering a competition. The way, at least the proposal from the Commission is framed, a bank will be able to get comparable revenue when offering digital euro services as when offering digital services with instant payments or with debit cards as comparable payment services. Yeah. Let me highlight something which is very important, I think, for not only for the perception of this is key really for the perception of the users, that both for cash and for the digital euro, the legislative proposal is enabling people to decide how to pay. It's bringing the logic that holding digital euro, holding cash, it's always an option for the payer. It's always an option in the sense that nobody will be compelled to hold or to pay with digital euro or with euro cash for that matter. But then if people choose to do so, they shall always be able to pay with them, with limited exceptions. You can see here how those merchants which would be already accepting digital means of payment, the regulation would require that they're ready to accept digital euro if their customer chooses to pay with a digital euro. From the perspective of banks, banks have then the congruent requirement of being able to provide it not to anybody, but at least to their own clients upon request, and to note that this is a requirement not applicable to all PSPs, but only to credit institutions. So this is, I think, a key element of bringing value and preserving a good balance between the value to build network effects which are necessary in every means of payment, with preserving people's freedoms to choose. Yeah, are there alternative ways to achieve uniform acceptance? This was covered in your paper, Marianne. You made the reference to PIX, by the way, but the logic actually in how PIX has been introduced in Brazil is not that different to the legislative proposal of the Commission mentioned here, where, as you say, the introduction of PIX was a requirement. So it had to be, there was a requirement of provision by the banks. There was a very valuable, it was very valuable for merchants. And it's the choice of the individual Brazilians whether to take or not PIX. So could we have done something like PIX in the US? We have certainly not tired from in the last 20 years from promoting European digital means of payments that would be uniformly accepted throughout the euro area. There are logical business obstacles to this. I will just give an example. Let's imagine that one payment solution is very successful in one country. Banks have made an investment, and it has paid off well because it's very successful. Would those banks give up that system to, and also because that's the case, if a new bank wants to enter the market space, then that from a pure business perspective, let's say the value that has been created has to be paid by the new shareholder. So would those banks which have payment solutions which are in different stages and which have different levels of success, it's very, very difficult there with competing business interests to reach an agreement. And then can it actually be forced from a regulatory perspective? So if promotion has not worked, can it be forced from a regulatory perspective? It's not really possible, because you cannot. It would be unprecedented to make legal tender a private form of payment and make it uniformly accepted throughout the euro area. Plus, which one would you choose? So it's not really. I don't think that there's an alternative way to what is central bank money, precisely because central bank money is the safest form of money in an economy. That is why it can be legal tender. So there's a connection. It does not need to be a means of investment, but because it's the safest form of money, it can be safely accepted by merchants. Let me highlight also, because knowing that the EU is a global leader in privacy and in the preservation of privacy rights, it was also very important for us. We have advocated on how we sought to preserve this, and the legislation is now being very specific on this. It's putting it's very helpful also from an institutional framework that the legislator is requiring to the central bank that in performing its necessary functions, it cannot see any private information. So in connection with this, there are two basic modalities of the digital euro. There's the online functionality, which has the value of covering all use cases. So it's possible for remote and for proximity payments, either for person to person, for physical shops, for online shops, for all use cases. And because let's say from the perspective of the functions, as I mentioned earlier, that the banks need to conduct the privacy is comparable to existing digital payments, in the sense that the banks need to perform the same AML, CTF, fraud checks, irrespective of whether they're processing money issued by commercial banks or money issued by the central bank, and that's logic. What is here in particular the value added when we speak of an online functionality is that as in the settlement ledger as processor, the Eurosystem would be seeing not be able to identify any user, which, let's say today, if you so that's a unique advantage. Also, there's an element that So let me turn to the offline functionality, because the offline functionality is closer mimicking cash features in every way, and it's in a way the closest one can come to anonymity. From the perspective, depends what definition of anonymous you use, from the perspective of how people perceive it, in the sense that a payment would only be known to the payer and the payee. That would be that is giving the highest privacy level in the same way that cash, in that only the payment is done from a secure device to a secure device, so that there's no need for any bank or central bank processing of that payment. Of course, it has the same features of cash, in the sense that an offline functionality requires proximity and can only be done up to a certain value, which the Commission will determine. Now, Dirk,
may I ask you to come to a close?
Yes, I will soon do so. You mentioned why would people switch to a digital euro? I would like to bring that. I think the relevant question is, will I add the digital euro to the range of payment options that I have? Why? Because the digital euro is not replacing any payment method, it's complementing them. and because people would like to have a variety of payment methods, and this is actually optimal for the resilience of the economy. So let me take what will be differentiating digital euro in the eyes of people. Offline payments are with your mobile phone are not possible today. They shall be possible with the digital euro, and they will be providing the highest level of privacy. From the perspective of what is processed in the central ledger, there will be more privacy. The processor will see less information than ever before. We are bringing in privacy enhancing techniques to ensure this. Very importantly, Maria, you mentioned financial inclusion. What we have learned from consumer associations is that digital inclusion is very important. There's been cases where with bank branches closing, people who are less savvy with digital applications face difficulties. So the digital euro would be bringing what is called a public approach. So it would be requiring member states to designate specific entities to make sure that those who do not feel confident can have a face-to-face attention and can also have other means of payments like cash. It's been said by the merchants themselves. It is making the acceptance market more competitive by providing a broad alternative. I put here the example of a restaurant in the Mediterranean coast, which 30 years ago, when cash was more widely used, had more negotiation power on whether to accept cards or not than it would have now. The digital euro will be available in multiple payment channels, P2P, POS, and e-commerce. And last and very important, like cash, it would be always an option when you travel. So even for people who may not want to completely switch to a digital euro, even in a case where you want to have, as I said, multiple means of payment available, having a means of payment which you know is always accepted will be very valuable. And I close here, happy to enter further the debate.
Thank you very much, Ignacio. Now, there is a first group of questions regarding the themes privacy, data protection, citizens' rights, trust in institutions. Morten argued that the central bank is the only trustworthy institution which is not likely abusing private data for commercial use. Now, if I look at the comments here and also in the public media, there is somehow the notion that people distrust public institutions to abuse the data that they collect for state purposes. Now, here in the chat, for instance, we have one question: how to guarantee that the digital euro wallets will not be blocked for people who disagree with the government? Now, this might seem implausible in a democracy, but I mean, looking across our borders, this is not so implausible. So it increases the power of the state vis-a-vis the citizen. And can the European Commission's 28th June proposal alleviate these concerns? How about data protection? How about cybersecurity risks? This is the first group of questions. The second group of questions relates to costs. Now, is this really cost efficient if you need a mobile phone to do a payment abroad? And another question from Otto Lucius: transactions cost money. Somebody needs to bear the cost. Who bears the cost if CBDC transactions are free of charge for the citizens? Where do the costs end finally? Then a third group of questions relates to alternative business models. Alistair Milne has put a couple of of comments here in the chat, which I cannot do fully justice to. But he argues, for instance, that maybe the ECB is overdoing it, overstretching the project. Is the project not too big? Does it not want too many things at the same time? Might it not be advisable, for instance, to cover different use cases with different instruments at different points in time? For instance, replacing cash in rural communities where you don't have a sufficient amount of ATMs, or providing subsidized banking and payment services for financial vulnerables. Do we really, is it really wise to aim for all these purposes with a single instrument? And then finally, there is a group of questions also by Alistair and by others who focus on aspects of wholesale CBDC, what this would imply for banks, whether the transition costs might not be quite substantial in terms of adjustments of IT and infrastructures and so on. So there are several questions, for instance, by Günther Duffy and others that relate to the big size of such a project. Maybe I give first again Maria the opportunity to reply to the comments by the discussants and to these comments by the audience. Thank you.
Thank you very much, Ernest, and thank you all for your interventions, and also thank you to our viewers. I've been reading the questions. Not only do I have some responses, but I learn a lot from the concerns of the audience. I think I'll start with the bigger one, and that is the privacy issue, because in all the discussions I have with, and I have had many in the past few months. Privacy is by far the biggest concern, and I want to just stress here that the guarantees for privacy are only as strong as the institutions behind that guarantee. This is very important to understand, and this is why I'm a firm believer that when the ECB tells us that the digital euro will be private, it will be private. It is because I have faith in the power of the institutions and the rule of law that governs those institutions. And if you don't have trust in the rule of law of a particular jurisdiction, you will have great difficulties with appreciating a central bank digital currency because of all the concerns that we've seen in the notes. So, but as far as the digital euro is concerned, I think that privacy is guaranteed because the institutional structures are guaranteed. Now, but what I will say, however, is that privacy is not the same thing as anonymity. These are two different things. And while I have no lack of confidence on the issue of privacy, the ECB had told us that digital euro will not be anonymous. And this is a concern for the citizens, and this is why the ECB has given us what they call now the tier anonymity. So for smaller amounts, it will be anonymous. For bigger amounts, it will not be anonymous. It's trying to deal with this concern. But as the numbers have also showed us, 42% of all the volume of transactions is done in cash. It means that the digital euro would be a very imperfect substitute for physical cash. And the question is, should we worry about this? I personally do not worry about this. I have no problem with the lack of anonymity. In most of the transactions that I, as an individual, engage with in any day are done digitally, and therefore anonymity is also not in place. But again, I think it's important to differentiate between the two and address the concerns of the citizens. On the issue of strategic autonomy, I urge you not to talk about strategic autonomy, but to talk about de-risking. I am coming to you from Brussels, where there is great instincts for protectionism. Unfortunately, it's not the EU who is driving all this, but the EU is responding to protection and instincts, and it's a lose-lose situation. From an economic perspective, the world will lose out. De-risking is a good economic strategy. It implies diversification. Strategic autonomy generates instincts that are protectionists. What is the difference between a digital euro and a euro that is used digitally every day? And the one is guaranteed in full, the other one is not guaranteed in full. But here I am totally with Dirk. Why should I switch between one and the other? If I have 100K in the Eurozone that is guaranteed, under a rule of law that I trust, I have absolutely no incentive to switch between one and the other. And therefore, I think Dirk may use this argument to say you shouldn't have limits on the digital euro. You should go bigger with this. Here, the only one thing I'll say is that it is not correct, in my view, to use a project like the CBDC as an instrument for changing the financial system. There may be good reasons why we want to think about the current financial system, but I don't believe the CBDC is either the place or the time to actually generate that change. However, I do agree, and this is my next paper, about the future of money in the context of a financial system which is moving in the direction of guaranteeing all deposits. And here the Silicon Valley Bank has been a very interesting case. And then finally, I want the ECB to think about one thing, and that is the following. What would it mean to the ambitions of the ECB and us as the euro area if the digital euro is launched, but is not taken up? Yeah, I think what would that mean for the future of the project? Because as we've seen also with the evidence from other jurisdictions, there are good arguments why European citizens might not want to take it up as another means of payment. And you know, what would it mean for the ECB if the euro were not taking up, let's say in the first year, in the first 2 years? And I think, would that kill the project? And I think the ECB needs to prepare for something like this and have a way of responding to the lack of enthusiasm, at least at first place, from the consumers. Thank you.
Thank you, Maria. Morten, do you want to go next?
Just two quick comments. Basically, I think in any cross-currency payment, you need somebody with a balance sheet in between to do the exchange between the two currencies. And currently that's done by correspondent banks. And I still think you need that even in the future. The thing that we've been looking at is really just by giving direct access, you know, you could, you know, speed up some of these processes. But I think, as Ignacio said, and I think there's some evidence out there, if you emphasize coordination and do that technically really well, you can achieve many of the same outcomes. And I would just highlight a project that we have out of our Singapore center called Nexus that is actually trying to interconnect not RTGS system, but these instant payment system across the world. And that's just a big lift. But still, you need somebody with a balance sheet or something with a balance sheet in between to do the FX conversion. And the other thing I would just highlight is I think I agree with Maria, like CBDC should not be the driver of a change in the financial system, but I think it would be a component of it. So in the BIS annual economic report, we lay out like a blueprint for how a future financial system looks if there is this movement towards tokenization. So this is really the scenario where banks or for the private sector is moving towards tokenizing securities and also tokenizing deposits, and then trying to put that all together onto a common platform along with the CBDC would be extremely powerful. And we argue there that there are three things that you that would be driving this. One is programmability, which is this, that you could actually program things. Composability is more about able to break down things and then making things conditional on each other. And the big vision is, and what would really change things is by putting all these things together, you could all of a sudden do things that we can't imagine that we can do today. And so it's a much more futuristic version. It's not just about tokenizing reserves. And I agree with Ignacio there that, you know, just doing that doesn't add a whole lot of value. You have to see it together with this potential wholesale change of how the financial plumbing actually works.
Thank you, Morten. Dirk, what's your take on the many questions?
Thanks, Ernest. On the privacy issue, I think it's, first of all, that was mentioned, I think, by Maria, you have to take a stance on whom do you trust more, your local central bank or your local bank, and that varies, of course, by person and by country a lot. So there's no general answer to that. I think it's important to distinguish between privacy, which means you can control information about you, and censorship resistance, which one of the questions I think was about. And I agree that if you're really concerned about censorship resistance, which means how can I prevent the government from preventing me from spending, for example, then you really want to go crypto, because you cannot trust your local bank because the government will influence, and you cannot trust your local central bank if you're really concerned about that one. So if that is the main issue you worry, then crypto is the answer, I guess. On the costs, I understand the ECB wants to make merchants pay to some extent for using that payment technology. Will this make merchants better off compared to what they're in now? I'm not sure. I mean, you have to understand that, of course, Visa and MasterCard, they will respond, right? Of course, they will become cheaper once such an option is available. And that comes back to what I said previously. This could be useful just in order to incentivize other market participants to behave better, even if it's not going to be adopted in the end. And then I think we also have to be a bit careful thinking about bank incentives. I think Ignacio mentioned that the banks will earn the same by making payments for us in digital euros than what they earn making payments in the current environment. But of course, banks earn a lot of money by creating money in the current system, and they would do less of that to the extent the digital euros are adopted. And that's a huge source of income for banks, obviously. So there is a lot at stake for banks. And I'm not sure why we would hope that they are behaving incentive compatible in the sense of pushing digital euros if there's something at stake for those banks. And finally, on the issue on should the ECB aim a bit lower, focus on particular use cases, I'm a bit skeptical because I don't know what the right use cases would be to focus on. I don't think the ECB knows that so much better than private agents. More generally, let me come back to my main point, which is that this is really about substituting private for public money. I think this is what retail CBDC can deliver. Maybe we want this, maybe we don't. And I understand Maria and also Morten were sort of skeptical whether this should be a reason to introduce it. I think in the end, this is the only reason. I mean, everything else you can in principle do by regulating banks or service providers in particular ways. If you want to change their incentives, do it like this. What we really have at our disposition now is to think about, who creates money. And that's what retail CBDC brings to the table. And that's, I think, what the debate should be about. Thank you.
Thank you, Dirk. Ignacio, last word for you.
Thank you. So first, let me clarify. The holding limit should preserve the successful balance which has existed for many years between cash and central bank money. But very importantly, in the case of the digital euro, the fact that the choice as to whether you hold commercial bank money or central bank money is not influencing whether you pay with a digital euro or whether you pay with a private means of payment. You should be able to pay with a digital euro while drawing the liquidity from your commercial bank money account if you want. That's part of our design. And you should also be able to pay with a private means of payment if you have your liquidity brought into the digital euro within the holding limit. So that is detaching, let's say, this question of 100,000 versus 3,000, the fact that you can pay irrespective, disconnected from where you hold the liquidity is something which I see is still not well communicated by us or well perceived. On the question on privacy, as I mentioned before, there was a question, so what if there's a requirement from a judge or whether there are sanctions to a country to block a certain account? So that's definitely not going to be done by the central bank. The central bank would not be able to see what to block. That would be done, as is today the case, by soliciting that to the relevant payment service provider. So the possibility to apply the rule of law is not changing in any way. What we're making sure, because that distrust in public institutions exists in certain sectors of society. So it's important to provide that trust every day and to show that the central bank will not be in a position to see and therefore not be in a position to take any action. On the question on who bears the cost, it's not, let's say, in terms of who today payments are normally not charged to the payer. Nobody pays to pay. It's normally merchant who are charged for the payment service that they get. We don't want to disrupt this market. at the same time with all merchants accepting digital euro, it's important that that is not abused to apply excessive costs. So I don't think that merchants are paying for the digital euro. Merchants will be, as I said, in a more competitive position to negotiate payment fees. The costs of building, of operating a digital euro could be normally expected to be financed through seigniorage. It's not taxpayer money which would finance the digital euro. So to the extent that so cash has been declining, to the extent that a digital euro is used even to a small extent, that generates seigniorage, which exactly like cash is financing the costs of providing one or the other. On the question on the use cases, it is let's say one could only foresee cash in the 20th century fulfilling all your payment use cases, whatever they are. As payment habits change, then public money needs to be available in more use cases. But ultimately, there's of course there's a project risk, and of course there's a case from a project perspective to roll out the digital euro in different stages. The euro itself was rolled out first in 1999 and second in 2002. So that's part of project management, to have a very clear idea of the end product, but at the same time having the rollout in a way which is feasible. And on the point on the Maria, on your point on the take up and the ECB's reputation, I think it's important to highlight that the statistics you gave for these countries are statistics for store of value. What is the share of CBDC in the total value, in the total share of money in these economies? But we have made we don't want to make a CBDC predominant as a store of value, but as a means of payment. So even if, take the case of China, even if it represents a very small fraction of the total supply of money, there are 250 million Chinese who are able and to a certain extent starting to use the Chinese CBDC today. So I think it's very important not to measure success in terms of taking a certain share of the money supply. From our perspective, success would be there if it is. We're also not aiming for any particular market share. When have central banks aimed to have a certain market share for banknotes? Never. Yet it's always been important that banknotes were widely usable and available. So with the proposal which is brought by the Commission in terms of legal tender, it's preserving, as I said, a balance where nobody is forced to take digital euro, and that's very important for the confidence and for the trust in the currency. But at the same time, by leaving that up to citizens while enabling an acceptance and an availability infrastructure which provides a value in terms of network, it is something which is facilitating a gradual uptake of a digital euro, which could also be very consistent with the gradual decline that one would see in cash. So I don't see success as don't expect something like the 2002 changeover, where everybody adopted euro banknotes. Everybody adopted euro banknotes because it was also known that the previous currency banknotes were going to be withdrawn. This is providing an additional means of payment to facilitate, as I said, a gradual uptake with the logic of complementing cash, which has a gradual decline.
Thank you very much. This concludes today's SUERF-Baffi Bocconi webinar on the value added of central bank digital currencies. Thank you very much to Maria, Morten, Dirk, and Ignacio for sharing your analysis and views with us today. A particular thank you to all of you for your participation and for your critical chat questions. I'm genuinely sorry that there was not enough time to cover them all. I'm sure that the ECB, the BIS, Maria and Dirk take them along for the further thinking and work. Thank you very much. I'm really happy about the very vivid and open and critical discussion. Bye-bye and take care.
Bye-bye.